You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Good. Happy Friday before the long holiday weekend podcast.
Yeah, podcast Friday. It is sunny and 48 degrees out.
Yeah, should be
Love
a nice holiday weekend. Looking forward to it.
Love it.
So today's topic, Dave, is kind of around this idea, and we hear it from clients from time to time, new prospects coming in, but it's really kind of around retirement and thinking about investing in retirement. A lot of people get this mindset of, well, I'm retiring, so I should probably put everything in CDs or bonds or safe investments,
Right.
Because I need to, start taking money out of there, so I don't want any fluctuation or risk, right?
Right.
And I think the bigger overarching point is, yes, both CDs and bonds are a useful part of most people's retirement plan. But there's a way to use them that I think makes the most sense. So I wanted to kind of talk a little bit about that, the proper way to use them. And then, we got some questions around this topic as well that I think will be useful to kind of get some answers from. So
Yeah. We tend to think of cash investments and safe stuff as easy things to talk about, but it always surprises me how people still struggle with how CDs work, how money markets work, and
yeah,
how that fits into their portfolio. And then compounding it right now, we have kind of this fairly unusual situation in the history of markets, although not unheard of, where cash investments are yielding quite a bit right now.
yeah.
And that, of course, gets people's attention too. So, and
Yeah.
we've done a whole podcast dedicated to that a few weeks ago,
Right.
but it kind of folds into this conversation too.
Yeah, it's an interesting dynamic because if you think back, 5, even 10 years ago, we weren't really having conversations around cash and CDs because they were paying basically
Didn't
nothing,
matter.
and people were
Yeah.
like, "Well, I'm pretty sure I don't want that because it's not paying me
Right.
anything." Right.
Right.
So a little
Now
bit
you
different
can,
now.
yeah, as of yesterday, you can find high yield savings accounts at 5% or better if you
Mhm.
look around. And the
Yep.
trick there is to remember it's not going to stay that. That's not
Right.
normal.
Yeah. Well, and even looking at CD rates, you can get lots of 6-month, 12-month CDs at 5%, but you
Right.
go further out that curve, and all of a sudden you're getting
Yeah, the
closer
bank's
to
not going to lock
threes.
you in. They're not going to be like, oh, let's do 3 years at 6% because
Right.
they know rates aren't likely. We should say never.
Right.
Shouldn't say never, but rates aren't likely to stay this high. It would be a very strange historical anomaly if rates stayed
Yeah,
this high.
for sure. So, with that being said, Dave, one of our questions that we kind of came up with in my scouring the internet about retirement investing, are CDs a good retirement investment?
Right. Yeah.
So, what say you?
Well, what do I say? CDs. We group CDs and savings accounts and money markets all together into that same
Mm-hmm.
group we call cash.
Yep.
And I tend to, when we talk about asset allocation, we tend to break it into three easy parts, right? There's cash, there's bonds, and there's stocks.
Yep.
And cash is good for your contingency funds,
Yep.
for money that you're going to spend, that you're going to spend in the next 12
Mm-hmm.
to 24, if you want to be conservative, say 36 months.
Yep.
It's defined like, hey, I need to do my roof next year. That's going to
Yep.
cost me $15,000, and I know I'm going to spend that. We do not put that in the S&P 500,
Yeah.
right? I mean,
Right.
and so just because you hit retirement, that same thought process still
Mm-hmm.
applies.
Mm-hmm.
And while these cash assets give you peace of mind because they don't move up and down in price, if this is money that's meant to generate your long-term retirement income and you're 65, that could very well be a 20, 30, 35 year, maybe more prospect, right?
Right. Mm-hmm.
And we tend to, it's not uncommon. We'll talk to a 62-year-old. Oh, well, I can't have any risk. I'm retiring next year.
Right.
Okay. Are you spending all of your money in the next 3 years? No. I
Right.
hope not.
Are you
Right.
planning on living
We've got other
longer than 5
problems.
years?
Like,
Right.
right. Like
Yeah.
asset allocation is not the problem if you're going to exhaust your retirement plan in the next 5 years.
Yeah.
So CDs play a role, money
Mm-hmm.
markets play a role, but they're not the be all and end all of
Yeah.
asset allocation in retirement.
Yep. Well, I saw an interesting thing, and I'm not sure where I ended up putting the article. It might be on one of our upcoming headlines, but there's a bank that's issuing a 100-year CD. I don't know if you saw that or
I
not.
did not. What are they offering on that?
I want to say it's close to 5%, but don't quote me on that. But it kind of
Yeah.
part of the reason I put this together was just that thought of like stuff like that's going to come up, right?
Right.
And it seems super enticing, but the devil's always in the details with things like that too.
Yeah. I'm not making a 100-year bet on anything personally.
Yeah, exactly.
But yeah, that's interesting. And we get I've also quite often in the last couple of weeks, because again, cash is on everybody's mind and rates are high. What's better, a CD or a money market savings account?
Yeah. Mm-hmm.
Okay,
Yep.
what's better? Well, again, we lump them both as cash because the
Mm-hmm.
long-term return, whether it's a CD or a savings account, your average is going to end up being a little less than inflation.
Yeah.
That's the
Yep.
long-term prognosis. And the difference between the two is money market savings is for money that you may need tomorrow, right? That
Right.
you may need to
Mm-hmm.
write a check for and move it into your checking account right away. A CD can insulate you against short-term interest rate drops. That's really the
Yep.
idea. So if you think interest rates are higher now than they're going to be a year from now, and you're putting money aside for your roof, then that's a good use of a CD. Okay. You're
Mm-hmm.
basically saying, I'm willing to lock in for 5% or 5.1 or whatever it is for the next 12 months because rates may go lower and I want to make a little more on that money.
Right.
The trade-off is if you need to liquidate it before then, you're going to forfeit a chunk of that
Yep.
interest. But
Right.
your return over time, as that CD, if you were just to leave that CD parked there, your return over time is going to end up being pretty much the same as if you left it in the money market. There's going
Right.
to be times when locking that rate in for a year was good. There's going to be other times when you missed out because you could have
Yep.
let it float in the savings account. But the
Yeah.
long-term prognosis is the same or very
Yeah.
close to the same,
Yeah.
negligible.
Yeah, I think that's one of those where like, we kind of we overthink it a lot of times
Right.
where like sometimes if you just do the math,
Yeah.
you're like
Yeah.
like
And
we both came up in the banks and so we know like the little old lady that would yank her money out and go across the
for
street for an extra
yeah,
$20 over 12
yeah,
months or whatever it
12,
is.
yes. It's the same mindset that will drive 20 miles to save a nickel on a gallon of
Right.
gas,
Yeah.
but and so we joke about it and okay, we're good financial planners, right? You should try to make the most that you can on your money
Yep.
within its given purpose. And
Yes.
if you are diligent about moving your money around, you can probably maximize that, but don't forget your time is worth something. It should
Yes.
be anyway.
Yeah.
And
For
unless you
sure.
get some kind of joy out of max, and I guess I've known a few people that probably enjoy knowing that they got 0.5% better
Oh yeah.
interest,
Yep.
so that's
Something to
fine.
brag about to their neighbors
Right.
or
Right. Right.
whatever the case may be. So yeah.
Yeah.
Good stuff. So let's flip a little bit here, Dave, and talk about bonds, because that seems to be a big, topic in terms of I'm retired now. I need bonds. Most people don't know exactly what that means, but
Hmm.
they've heard it somewhere along the lines of, I'm retiring, so I need some bonds.
Yeah. 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 A lot of people, like smart people that I know, couldn't define what a bond is if they were
Mm.
pressed. Most people
Mm-hmm.
understand a stock is a share of ownership in a company, right?
Yep.
You're
Right.
participating in the growth of those earnings. A bond is essentially a loan. It's
Mm-hmm.
like you're the mortgage holder, and it
Yep.
has a fixed term usually. There's lots of different flavors, but usually it goes for a fixed term, usually with a stated interest rate that it pays. And hypothetically, if you own that bond over its lifetime, you get your face value of the bond back plus
Mm-hmm.
the interest that you've earned. What
Mm-hmm.
makes bonds unique is that they can be bought and sold on any day the market's open.
Yep.
So we're not talking about savings bonds, of course. Double E bonds,
Yeah.
those are different. But your typical bond, I can buy it and then sell it to you in a couple days, the same way I would trade shares of stock.
Right. I think that's part of the surprising thing for people about bonds in general is like the bond market is 3 times the size of the stock
It's
market,
a
right?
huge market compared to the stock market. Yeah, there's
And
a
there's
lot
all
more
kinds
money
of
involved.
different flavors and risk
Hmm.
profiles, and like you can get yourself into a lot of
Yeah,
riskier situations,
yeah,
even though
yeah,
on paper, in theory, like bonds are seen as safer investments,
yeah,
right?
yeah. Do we want to take a minute and talk about the different types of risk in the bond
Yeah,
market? Okay.
let's do it.
So on one end of the spectrum, there's two things to think about in my opinion when it comes to bond risk. One is credit worthiness of the
Yep.
bond issuer. And again, you're the lender here. So kind of like the bank is going to look at your credit history if they're going to loan you money, and they're going to
Mm-hmm.
charge you a higher interest rate if you don't have a great credit history, and a lower
Right.
interest rate if you're considered safer, right? It's
Yep.
the same in the bond market. Then the other factor to consider is what we call duration
Mm-hmm.
and or term. How long is that bond?
Yep.
And so on the safe end of the spectrum are
Mm-hmm.
really high credit, very good credits that are very short. So like
Yep.
the typical example is treasury notes issued by
Yep.
the US Treasury, considered the safest bank in the world. We can debate that in another
Yeah.
another topic, but as of right now, the US Treasury is still considered the safest investment.
Yes.
And so treasury notes are measured in months,
Mm-hmm.
and then out, if we want to stick with safety, then there's bills and bonds, out to 30 years potentially.
Right.
And then on the other end of the spectrum, there are high yield bonds, which is a nice way of saying junk bonds. And
Yep.
those are like the credit card debt of the bond world. That's
Yes.
companies that may or may not survive to pay you back all of your face value. They're going to
Right.
pay high interest, right?
Yep.
So go ahead.
The marketing machine that is Wall Street, right? A high yield bond sounds like something you want. A
Sounds
junk bond
good,
sounds like
right?
something you don't want. Yet those are the same
Right,
things.
right. Yet you'll still hear about billionaires that made their money as the junk bond king.
Yeah,
So,
right.
so it's like juggle that one. But
Mhm.
so when you look at a bond, um, individual bonds, that time factor, how long and during, because if it's short, the future is fairly certain, right? That
Yeah,
that company's going to be here, 6 months from now to pay you back, is a lot different than 15 years from now.
right.
So that would require more interest.
Mm-hmm.
Hmm.
Yep.
So anyway, um,
So how do we think of bonds in an overall portfolio? Like as a retiree, how should I be thinking about using bonds?
so there's two ways to think about bonds in your portfolio. One is that interest payment, right?
Yep.
So when we hold bonds or hold a bond fund, we're having income come into the
Mm-hmm.
portfolio, which cushions ups and downs in the market. And then the other thing is the diversification factor. And
Mm-hmm.
that is the idea that bonds generally are negatively correlated to the stock market.
Right.
And I guess to put it simply, most things that cause the stock market to go down are actually a positive for bonds,
Yep.
and vice versa.
Mm-hmm.
And there's lots of dynamics there. And in 2022, we saw a situation where the economy was lousy for reasons that were bad for both bonds and stocks. And that was a
Right.
rapid rise in inflation.
Yep.
But if you think about, let's go with a concrete example of during the 9/11 is a good example.
Mm-hmm.
Stock market went down after 9/11 briefly because of fear, right?
Yep.
There was a shock to the system. What's this going to mean for the economy? Are more attacks coming? What we call the risk off trade. People were getting out of risky assets and buying safer assets. We saw the bond market, particularly government bonds, go up in value while the stock market went down.
Mm-hmm.
So there's that yin and yang, if you will, between stocks and bonds. That is a very good reason why we mix them into portfolios for retirees.
Yeah, absolutely. And just going back real quick to what happened in 2022, right? Like,
Hmm.
yes, these things work out most of the time, but if it always worked out, then
There'd be no,
like,
there's no, if there's no risk, then there's no
yeah,
reward. You might as well have it.
exactly.
The return would be the same as a savings
Right.
account then.
Yeah.
So
Yep.
yeah, and a couple to kind of build on that too is bond prices went down in 2022, but we also know that if we own good bonds, they're going to build their value back because they mature at their face value. Plus, they're paying us interest. And if you own bond funds and they dropped in value because interest rates went up, now those bonds in that portfolio are turning over and they're buying bonds at higher interest rates, so that income is coming up.
Right.
So there's lots of little nuances to it that help support and take out some of that volatility and downside over time.
Yeah. Yep. So I want to talk a little bit about, because this kind of gets thrown in the mix as well. Like, as a retiree, what I mean, just looking at it from constructing a portfolio, like, do I want to have individual bonds? Do I want to have a
Mm,
bond fund? Like, how do I make that decision around? Do I just go and get
yeah.
like a treasury, or and just get that interest, or do I want something more diversified like a bond fund? How do I think about
Yeah.
that?
Well, there's a lot of little nuances that are individually pertinent in this situation.
Hmm.
So, um, when you buy a bond fund, you're getting two things. You're getting diversification and
Hmm.
liquidity. So again, diversification is important if you're buying, particularly if you're buying corporate bonds. You don't want all your bonds to be one company.
Right.
Ask General Motors holders in 2008,
Yep.
2009, right? Um, so a fund takes that risk out of the equation, and a fund also makes it easy to go in and say, hey, out of that $50,000 in that bond fund, I need $2,000 to fix the hot water heater.
Right.
Okay. It's fairly liquid. It's easy to
Hmm.
buy and sell.
Hmm.
Not that that's necessarily the best choice, but that's a whole different part of the puzzle. When you own an individual bond, the advantage is you know your terms, right? If
Right.
you buy a 10-year treasury note today, you know what the interest is going to be, and you know that 10 years from now it's going to mature at its face value, and you're going to get that money back into your portfolio as
Right.
a lump sum. And in the meantime, its price is going to fluctuate, but you've kind of defined your worst case scenario as you hold that bond to
Hmm.
maturity and you're going to get your 5% or whatever the yield happens to be today. And I have not looked, so don't quote
Yeah.
that. but that's the advantage. The other side of that equation is it's harder to go in and sell pieces of that bond.
Right.
Bonds are bought and sold like wholesale and retail. So if
Hmm.
you buy, when you see the price of your bond in your portfolio, it's quoted as though you owned at least $100,000 of that particular bond.
Right.
And if you don't, the price you get when you go to sell your bond is not going to be the same as that big block,
Right.
especially if you're going in and saying, oh, I need $2,000 out of that bond. So the point isn't that either one, in my opinion, you can diversify your bonds if you have enough money to invest in bonds.
Right.
You can buy really super high credit and not worry about it. Like, if you bought all treasury bonds, if the US Treasury defaults on their bonds, we've got other problems to worry about.
Yeah.
I mean, I don't want to get into the doomsday spiral, but you know, that's so, you can decide how important diversification is, but then it's still, you've got to have enough bonds for that liquidity issue to make sense, or you've got to have enough other money to be able to say, I'm not ever going to sell part of that bond.
Right.
So
Yeah, just different ways to think about it, different ways
yeah.
to put things together, and this kind of leads to our final question point here, Dave, and that is, what investment is best for retirement? How do you figure that out? We've already kind of
Hmm.
established that CDs, cash should be a part of your overall plan, bonds should be a part of your overall plan. So how do you think about, like, how do I put all this together now?
Yeah, yeah. Well, the cash part is sometimes easier to quantify
Right.
because there we basically set that up looking at how much you need in contingency funds, how much you're going to need to spend in the next year or two. Maybe we build a little cushion into that,
Yep.
you know, and whatever that number is, that should go into a high yield savings account. If somebody knows some of it's going to sit there for a certain amount of time, CDs are fine. I don't see a lot of advantage to it. I use them myself, though, a little bit.
Yeah.
Um, so, that part is a little bit easier to define. And then the stock and bond equation really comes down to a combination of how much money we need to take out of the portfolio at any given time
Yep.
and your risk tolerance.
Right.
So if your withdrawal rate is low, say less than 3 or 4%, you can have more of that money in stocks because we don't have to worry as much about in a bad market selling too much to recover.
Mm-hmm.
If your withdrawal rate is fairly high, we have to be more careful.
Yep.
Um, that's kind of a ambiguous answer in a way, but
Yeah, unfortunately, there's no easy, like, hey, you should have this percentage in here, this percentage
yeah.
in here. Like, it all depends on, and I guess, like, taking a step back, what you should be doing heading into retirement is creating a
Hmm.
plan so you kind of know what your withdrawal rate's going to be, how much you're going to have in cash, and then you can kind of figure out
Yeah.
based on your risk, like, how do we
Yeah.
put all this together now? There's
Well,
not a one size fits all answer, right?
so let's give some examples from how we do it with clients. I think that might be the best way.
Mm-hmm.
So we have our basic models
Yep.
that we use, and they're in 10% increments of stock exposure, right?
Mm-hmm.
So on the low end, we've got 10% stock, 90% bonds. We can do 100% bonds. That's actually riskier than being zero stock, but that's
Yeah.
another conversation too. All the way up to 100% in stock. And then we take it and we plug it into our financial planning software and look at, okay, if your social security is going to account for this part of your spending and these are the things we know about, then this is how your portfolio should behave. And anything over 70% in stock, we start to see worse results.
Yep.
As an example,
Mm-hmm.
with some people, we're able to say, oh, you could have as much, you can look at it as the glass half full or the glass half empty, take all the risk. You're still going to be okay, even if the stock market drops precipitously because of
Right.
your spending versus your assets. With other people, maybe it's, we better not be more than 40% in stock because we start to see diminishing returns in the plan.
Right.
Okay. So that maybe doesn't give individuals listening to this much specific advice. What I would say, if you want to like look and get a good idea, go to Google Vanguard Retirement Date Fund Glide Path.
Yep.
And so target date funds, we've talked about these before, but they're going to basically give you an appropriate portfolio in that company's view for whatever year you plan to retire.
Mm-hmm.
And it's not perfect, but it'll give you an idea of, okay, if Vanguard's going to be somewhere around 60%, 55%, 60% stock, I believe, right around your target date for retirement, and then
Mm-hmm.
keep it fairly constant throughout retirement.
Right.
Whereas, if you look at one that's 30 years out from retirement, it's going to be close to 100% stock. So I have no qualms about somebody who's not going to hire an advisor and doesn't want to use one of those target date funds themselves. Steal from it. Look at the asset
Yeah.
allocation. Look what they're using. Compare a couple of them. State Street, BlackRock. They all have target date funds, and I believe you should be able to find the glide path.
Yeah.
Is the term we use.
Right. Yeah. Yep. No, that's a great starting point. Like we said, everybody's kind of a little bit different on where they fall
Yeah.
based on their plan. But if you've got no other resources to use and you're kind of wanting to do it on your own, that's a great place to look at what
Yeah.
professional money managers are doing in terms of
Yeah.
putting those
Yeah.
together. So
I just
I like that.
I just kind of wrote about this morning that I don't believe target date funds are the be all and end all. They're not what I would do if given all the choices to invest your money however I want. But if I'm never going to see you again, or if my
Hmm.
options are limited, I know that you're going to be in pretty good shape.
Right.
You're going to be
Yep.
close enough that we can believe in that.
Yeah. I mean, if you look
So
at like all the things you're trying to achieve, like the target date funds check off a lot of those things.
right, right, right.
Right.
It's not as nuanced or fine tuned as you would get if you worked with an advisor, most likely,
Right.
but it's going to get the job done.
Yeah, for
So
sure. Yep.
yeah,
Well, this has been great. If our listeners have any questions, feel free to shoot us an email at info@srbadvisors.com. We love hearing from you. And Dave, as always, it has been a pleasure.
it was fun, Nick. Thank you, sir.
This is a Zedia Media production.